So that was the Santa Claus rally, and Ken goes on to explain it in a video he does for Real Vision. I'm not going to play it here, but I'll put a link to it inside of the description. Um, he explains why the Santa Claus rally happens, and that's because of the when the stock market goes up by the end of the year, the collateral value goes up. And so I think the market's up what 20% this year. And so if it closes that way, well then there's more money to be reinvested in January from people whose portfolio, their assets are not worth more. And so you have people who front run that in November and December, knowing that they're going to be forced buyers in the beginning of the next year, and then the year starts, and then those buyers buy in. I mean, they don't go all in right away, but they do start buying as of January because their their history is now wiped clean. They could start again now from January, and they could start putting those positions on, and they don't really have a choice of not reinvesting that money in, right? If they have a $10 billion portfolio and that portfolio goes up by 20%, well, they have to reinvest extra more money because they're already leveraged and they have to continue with that leverage in order to keep their risk steady, which is what they're promising their customers. So it's really fascinating that the dynamic of rising assets causes more rising assets,
Hmm.
and that the amount of money that's required to move, let's say, the S&P by 2% is like $100 billion, like $50 billion for every 1 percentage point. So you can imagine a $60 trillion market that goes up 20% in value has trillions of dollars now that can then be reinvested. If you have even a fraction of that that goes into the markets, well then you're going to have massive moves to the upside.
Fascinating. I definitely need to spend more time watching his stuff, and I really lean on you, Tom, as my guide here on the options side. Admittedly, options are less of a. I haven't gone down the rabbit hole for options. Let's put it that way. I've been in crypto and stocks and in futures for much longer and much deeper rabbit hole. But I need to get up to speed. You got the edge here.
Well, I wanted to. I was actually going through when I went through for this show to get clips for all this. I have whole sections of explaining more 101 that Kim does, the sort of effect and the value of options. But I was like, okay, I'm not going to put a half an hour thing into here. But it might be interesting to share some of these clips out on not just from him, but also from Michael Howe and from Lacey Hunt and from different participants who have pretty significant knowledge with the bond market, the futures and options, because I think it would be interesting for people who watch us. But the thing I wanted to bring up is that he really makes the case, and I never heard him make this case before, that options, he considers the equities and futures to be a derivative of options, because the stock is essentially a two-dimensional view of what the asset is, whereas the options gives you um, the whole volatility surface and takes the future into consideration. And so you get this. It's almost like the stock is a 2D representation snapshot of right now of what the option space is actually doing. And
Mm-hmm.
because it's leveraged to such a degree and there's so much money there that the options could end up moving the price, like we just saw. The dealers have to then cover, right? They're selling you puts because you think the stock market might go down in September. Well, they sell you the puts, which is they're giving you an insurance that if it goes down, they'll pay you out. Well, they have to hedge. They have to go sell the futures now. They have to sell the futures now so that they can sell you that put. And so when the put doesn't get monetized, well, now they have to buy back the future. They have to buy it back, and so the options are actually helping to drive large players, even though retail investors or some institutions are buying insurance. They're the insurance. They're the insurance market, so they can't be. They have to be delta neutral. They can't be directional in any way. And once we get that in our heads, that the way that the option space is structured is completely informing long-term decisions, completely modifying the flows within markets, then it becomes like, well, not understanding an understanding of what the options are telling us gives you a leg up on the spot price. So the trades I've been making recently with Bitcoin have all been based on this sort of idea that uh, we know that these flows are coming in. You're the one who taught me that about VWAP, and what I didn't understand was that I was like, why is it responding so well? Why is the price responding so well to the volume weighted average price? Until the book that you you showed me from Brian Shannon explained, it's because the institutions are using VWAP.
Mhm.
And because they're using it, you have this feedback mechanism where you get to see a little bit of how they're making their plays. And if they have to buy $10 million worth of shares, they're just not going to buy it at any given price. They want to get a price that's less than the volume weighted average price, or short it higher than if they're shorting it. And now it makes total sense. Why is it bouncing there? Well, because there's an order there for 10 million shares that needs to be done over the next 3 weeks.
Right.
And then it goes up, and then it pulls back, and it goes up and pulls back. You're like, okay, now it's making sense. And options are essentially the same sort of way in the 3D model, in the 3D space.
Yeah. Yeah. And I found that VWAP, especially across asset classes, tends to correlate pretty highly. Even looking at like VWAP of the underlying constituents or components of an index tend to line up with the index itself. So I would imagine that institutions, even those that are selling options, tend to have to dance around the VWAP line as well.
That's right. And I love that idea that let's say some institution wants to buy a large block of shares, so they hire a broker or some uh, person to do it, and that person they essentially sometimes have to guarantee beating the VWAP price. Like you were telling me this on Wednesday that Warren Buffett will put in a trade and he'll be like, well, guaranteed VWAP level, and the person buying the shares sometimes has to take a hit on it because they have to give a price that's equal or better than VWAP. And I just love that sort of knowledge. It makes me feel like I'm I get to peek behind what's happening in the big leagues, because as a retail investor, you're not there like, oh, I have to make sure I get the VWAP price. But the idea that millions or billions of dollars, they need to depend on that, makes me feel like a lot more control, a lot more edge in my trading.
I totally agree. I think that there's anytime you can follow the flow of capital from a volume perspective and understand who makes up that participation and where the majority of that activity is coming from, it does give you a better understanding of how markets are really constructed in terms of the cohorts of participants, right? So you've got the institutional involvement, you've got high net worth individuals, you've got investment banks, you've got retail, and all of those flows in aggregate represent some pretty large percentages of the reason that price moves. So watching how institutions respond to certain technical levels pretty consistently is helpful, because it gives you a better and stronger understanding of why markets respond at certain price points. In general, I think the vast majority of retail traders are sort of taught this basic understanding of support and resistance. And I think that becomes in many ways a self-fulfilling prophecy as we get to areas of resistance and we start noticing that rejection and we get confirmation of that rejection. There's a crowding effect, and then everybody's jumping at the opportunity to sell that rejection because that starts to give us some belief that this is how people are going to respond, and then it's like a giant echo chamber. So the understanding the structure of markets and why participants are behaving the way that they are does give you that edge in my mind as well.
And explains the sine curve you see in markets. You go, why is it going up and down in this oscillating wave? It's
Sure.
because it's human emotion and desire and behavior that's
Yep.
then affecting. Because it's not going to bounce off support. If you get the guy who says it's not going to bounce off support, but then it does bounce off support, you go, oh, but I got to get back in because now it's going to go the other way. And then they go in, and it turns out, oh, it's not in support or not in the volume. Now it comes down the other way, and then it gets back to support and goes up. And the person says, well, now it's the second time it bounced there, and I wait for the second touch, and then you have a new set of buyers that go in, and you're like, oh my god, this is such a fun game to see.